If you've clicked on this video, you're probably interested in working in finance, and you might be wondering to yourself, what are some of the most important skills you need to have in order to break into and be successful in this industry? Now, you might be going into college, or you're currently in college, or you're just entering the job market, or you may be pivoting from a different industry. Whatever your situation is, these 5 skills that I'm about to tell you are ones that you can start working on right now in order to put on your resume, stand out in an interview, or immediately impress your team once you join the desk. And to clarify, these skills will mostly pertain to the market side of finance and are ones that I've identified over 3 years working at JP Morgan and now a hedge fund that are essential to traders, portfolio managers, and risk managers like myself. See if you can answer this question. Non-farm payrolls printed softer than expected. What are treasury yields likely to do? What will stocks do? What about gold? One of the most important skills to have when working within the financial markets is to understand how markets behave. Now, for better or for worse, this is an impossible yet necessary task. On the bright side, it keeps things interesting and challenging, but on the negative side, something that may have been true in the past may not be true in the future, and so you'll constantly have to be updating your strategies and your frameworks. And the reason for that is because markets are unpredictable. Given that markets are just made up of people and algorithms making investment decisions based off of incomplete information, it can be easy for markets to become irrational and do things you may not expect. Just like that John Maynard Keynes quote goes, markets can remain irrational longer than you can remain solvent. If you try to fight the market, that is a quick road to ruin, so it's important to stay open-minded and adaptable. Now, just because markets can be irrational doesn't mean we shouldn't try to understand the underpinnings of what drives the market. Let's go back to the question that I posed in the beginning of this section, which is, how does a piece of economic data like non-farm payrolls affect different markets? When I was browsing for clips to use in my previous YouTube videos, I came across this clip from the HBO TV show Industry, which is actually about the world of banking and trading. Now, I haven't seen the show personally, but this clip actually does give a pretty decent example, albeit a bit dramatized, of how a trader might react to an important economic data point like non-farm payrolls.
Plus 120 versus Street at plus 250.
What did I say?
Told you.
Okay, pull up the trade and put loss sheet. I shouldn't be doing this.
It's already done.
Execute anywhere within 10 grand and you might get away with this.
This moves one-way traffic. Printed soft, I'm running it.
Harper, don't f around. Cover that risk now.
So the clip starts off with her being long the British pound US dollar pair, aka cable. Here's a quick fun fact. This currency pair is actually nicknamed cable because the first exchange rates between the pound and the dollar were transmitted using undersea cables that ran across the entire Atlantic Ocean. Okay, now back to the clip. It actually seems like the protagonist accidentally placed this trade, and the person on the phone that is talking to her is someone from the middle office who is in charge of booking the trades and is telling her to get out of this position. That's when she sees that the non-farm payroll print is softer than expected, so she holds onto the position for a bit longer, hoping to exit out at a profit, and lo and behold, the pound strengthens. Okay, so why does this happen? Well, first, what is non-farm payrolls? As the name suggests, this data point measures how many people are employed in the US, excluding farm workers and a few other categories. On the first Friday of every month, the Bureau of Labor Statistics will publish the month-over-month changes in these payroll numbers. So when it prints softer than expected, it means not as many jobs were added in the prior month as was expected, signaling a weaker labor market and likely slower growth in the US economy, which means the Fed will have to loosen monetary policy to support the economy, and that translates to lower yields in the US. When there are lower yields, that generally makes that country's currency less attractive to other countries' currencies where they could potentially get a higher yield. So the currency will sell off, and in this case, the pound rallies against the dollar. Now, of course, there are many other factors at play as well, such as how economic growth and inflation are playing out in other countries, trade dynamics and tariffs, and geopolitical events. This is a good example of what I mean when I say you can never fully understand the markets, because the market could fixate on different things at different times, such as now when global inflation is front and center, people might be less concerned about something like the trade balance numbers, even though those should still theoretically have an impact on supply and demand of a currency, but that just may be having less of an impact now. And this is just foreign exchange. To be successful in the finance industry, you should also have a fundamental understanding of what drives other markets like fixed income, stocks, commodities, credit, and how an event that occurs in one market can have a ripple effect that affects other ones as well. And this is when you start to see just how daunting of a task this is and why people spend their whole lives studying this stuff. But in order to help with that, I'm excited to announce that I am partnering with Seeking Alpha to provide you guys with an incredibly useful tool for developing your market knowledge. Seeking Alpha is a website that I myself have been using for years and has a countless number of articles that you can read through to help you get a better understanding of these concepts I just talked about. They have analysis on virtually every topic you can imagine, from different asset classes like bonds or FX to topics like the economy as a whole, investing strategies, or my personal favorite, stock ideas. They also have the latest news on a number of relevant topics like like global macro, the US economy, company earnings, and more. They even have a section of the most important market data neatly compiled so that you can easily see, for example, where the US 10-year is trading, where the S&P 500 is trading, where oil is trading per barrel, and much more. Now, I believe Seeking Alpha is technically free to use, but there is a limit to how many articles you can read unless you upgrade to a premium version. The premium version costs $239 a year, which I already think is not too bad. But if you click the link down in the description below, you can get 20% off the yearly subscription, which translates to just 50 cents a day, which I think is just incredible value for that price, especially since some of the information and analysis is honestly on par with what I get from my Bloomberg terminal, which costs $25,000 a year or more. I would be recommending Seeking Alpha even if I wasn't doing this partnership with them. I think I even mentioned them in one of my previous videos, but now you can get the premium version for 20% off. And even if you don't want to subscribe to that, I would still recommend you check them out regardless. The second skill you must have is knowledge about the different financial products. Now, this can also get pretty complicated and new financial products are literally created every year, but I think the most common ones you are likely to come across and you should have at least a basic understanding of are stocks, bonds, futures, and options. I'd also say currencies, but I'd say that's more about understanding the markets rather than the underlying mechanics, since currency trading is just exchanging one currency for another, or it'll be traded through derivative products like swaps, futures, and options. Although this video isn't about financial instruments, I'll still go rapid fire through these and briefly try to explain what each of them are. As for the first two, stocks and bonds, these are probably the ones that you've most commonly heard of and are the ones that are most accessible to the average person. Stocks, they're pretty straightforward. Shares of a company, their price goes up and down depending on the supply and demand of the company's shares. And when you buy a stock, you're either looking to profit off of the price appreciation or having the company pay out its earnings in the form of dividends. Bonds. For the longest time, bond trading wasn't terribly exciting with interest rates anchored at 0%. But now, thanks to inflation and central banks raising rates, bonds are cool again. Unlike stocks, bonds are debt instruments issued by governments, corporations, municipalities in order to raise capital. So when you buy a bond, you're effectively loaning money to that entity and they're paying you interest in the form of coupon payments. Then when the bond expires, you get the money that you loaned back. And here's another fun fact. The reason they're called coupon payments is because back in the day when bonds were still issued in paper, you literally had to rip off the coupon from the bond in order to redeem your payment. Now, there are a lot more nuances to the bond market and bonds in general, such as how the bond's yield and its price move inversely to each other. But this video isn't about bonds, so I'd encourage you to do some reading on your own, and let's move on. Up next, we have futures. Futures are essentially a contract to buy a certain asset at a specified time in the future at a predetermined price. Now, futures actually started off being used by grain farmers to hedge against commodity price risk. Producers would enter into these contracts where they could sell their crop at a predetermined price, and buyers could buy at a predetermined price so that there are no price spikes or crazy fluctuations for either party that are caused by factors outside of their control, like the weather. In the modern day, some futures are still used in that fashion, particularly the commodity ones, but now futures are increasingly being used as speculative instruments by traders, since one futures contract gives you a large exposure to that asset and you only have to put down an initial sum of money known as margin. For example, one contract of the S&P 500 E-mini future gives you the exposure of about $250,000 worth of the S&P 500 index, and you only have to put down margin of about $13,000. Another reason why futures are pretty popular as speculative instruments are that they're pretty liquid and are traded as standardized contracts on exchanges like the New York Mercantile Exchange and the Chicago Mercantile Exchange. Finally, we have options, which are similar to futures in that they're also a contract to buy an asset at a specified time at a specified price. But the main difference is that with futures, you are obligated to buy or sell the asset. But with options, as the name suggests, you have the option to buy or sell. Therefore, unlike futures, which have a linear payoff, as in you could have an infinite loss or an infinite gain, options have a capped loss, which is the amount you paid for the options contract, aka the premium. For example, if the price of the underlying asset falls below the predetermined price, aka the strike price, you simply don't exercise the option and it expires worthless. There are two types of options. A call option is used to speculate on the price of the underlying going up, and a put option is used to speculate on the price of the underlying going down. In the case of a call, you make money when the price of the underlying asset goes above the strike price because you can then buy the underlying asset at that predetermined lower price. And it's the opposite in the case of a put. You make money when the price of the underlying asset goes below the strike price because then you can sell the asset at that higher price. You can also go short these contracts and also combine them or mix and match them in different ways that is entirely out of the scope of this video. Once you finish learning the basics of options, you then need to learn the Greeks. Learning the Greeks are an essential step to understanding options because all these metrics combine to form the price of the option, and each of them individually will tell you your exposure to the different risks associated with options. Again, this can get very complicated very fast, so if you want to learn more, you can always pick up a copy of Options, Futures, and Other Financial Derivatives by John Hull, or if you're not feeling that, you can always check out the YouTube channel In the Money. He has a lot of great videos on options and he breaks them down in a very simple manner. The next skill you must learn is basic statistics. Now, the extent of my formal education in stats was just one intro to stats class that I took during my sophomore year of college, so I'm not exactly sure what will constitute as basic, but essentially here are a few concepts that I find myself frequently using in my daily work, and I'll try to give an example of how I use it in each case. Variance, covariance, and standard deviation. First off, you have standard deviation, which in modern finance is the measurement of volatility. And this is used in many areas of finance, from assessing a security's risk to pricing options to assessing a portfolio's performance by calculating your risk-adjusted returns using something like the Sharpe ratio. You also have variance and covariance. With these two concepts, you can calculate things like portfolio variance, which you can use to compare portfolios and see if certain assets are contributing positively or negatively to the overall variance or risk of your portfolio. On a similar note, we also commonly use concepts like correlation and regression to identify the strength or the direction of the relationship between two different assets, or say pieces of economic or financial data. The last one is probability, and more specifically probability distributions, which are commonly used to model the range of possible returns for an asset or portfolio, such as VAR tests, which are used to estimate the probability of losses under a potential extreme market move, and is a crucial risk monitoring tool to make sure that the portfolio doesn't lose too much money given a crisis scenario. I might be missing a few concepts here or there, but these are essentially the ones that I've most seen commonly used in the world of portfolio management and trading, so hopefully that can give you a sense of what to expect. I feel like even just a few years ago when I first started working, there was only a few select number of people that I worked with that knew how to code. Now, fast forward 2 years, it now seems like everyone that I run into in the workforce can at least code at a basic level, and now most job postings that I've come across also seem to require some sort of coding skill. But more recently, ever since I learned how to code myself, I've really come to understand the value that automating daily processes can have. While it may seem like a big upfront task to write a script that only saves you 15 minutes a day, those 15 minutes every day can quickly add up, not to mention the amount of time that you save your team even after you leave the role. It also unlocks a whole new realm of quantitative techniques like principal component analysis or machine learning, which is difficult to do in some cases and impossible to do with others with just spreadsheets, but can be implemented in just a few lines of code with Python and the scikit-learn library. Now, you might be wondering, how do I learn to code from scratch if I didn't study computer science in school? Back when I was at JP Morgan, every year they would have week-long boot camps intended on teaching us how to code. We'd get on a Zoom call and there'd be an instructor teaching us about different Python concepts like operators, data types, for loops, you name it. Now, during the sessions, I felt like I was getting a grasp on how to code, but as soon as the boot camp was over, I would slowly forget what I learned as the weeks went on. So in my opinion, the best way to learn how to code, and is the way that I actually found some traction with, is to find something that you're trying to do with code and just searching up the steps to do just that. I'd suggest you start off with something simple, but something that interests you. Like say you want to write a script that pulls in stock market data and then calculates their monthly volatility. This would already teach you some pretty useful basic Python techniques like how to read an Excel file, how to manipulate a data frame, and how to perform some basic calculations. But as you repeat the cycle of writing code, then running it, then getting an error, and then going on Google or Stack Overflow to search up how to fix that error, you'll naturally start to build an intuition on what might be causing an error, and you'll also start to remember how to write certain lines of code to perform certain tasks without having to search up every time. Essentially, it's just learning through trial and error. Now, I can't guarantee this method will allow you to become a professional coder and then pivot into software engineering or anything, but I can attest that this method of learning by doing helped me to learn how to code the fastest, and in just under a year, got my skill level up to a point where I could actually start to write programs that could perform useful tasks, whereas after all those hours of those boot camps, I retained very little information. The last skill I want to talk about is communication. Excluding sales, you might think that a markets-related role doesn't require very strong communication skills since you're not dealing with clients directly, but you still need to be able to communicate your ideas and analysis to your team members and to upper management. I'll be breaking down communication into two categories. The first is written and verbal communication, and the second is data visualization. As for the first, it's very important to communicate your ideas in a clear and concise manner, to not only respect people's time, but to actually have people remember the main points you want to get across. For example, when I used to work for a bank, I would lead a weekly meeting with my team and my managing director where I would update her on things like risk, P&L, trading volume, how certain markets are performing, and usually some pieces of analysis that are relevant for that week. So despite all that information I had to cover and given my MD's limited time, I still had to communicate all these things in a timely manner and in a way that she understood so that she could go to her superiors and report on how the risk for the public finance department is doing. As for the second part, data visualization, graphs and charts can be an incredibly useful enhancement to your presentation, or they can be a really quick way to utterly confuse your audience and ensure that they have no idea what you're talking about.
Oh my God, bro. Oh, hell no, man. What the?
Therefore, it's important to first learn when and where to use a chart or graph, and two, which chart or graph best serves the situation so that they can actually help you get your point across and not detract from the message of your presentation. I'll leave you guys with one more tip that my former boss at JP Morgan would always tell me, and that is to always think about the story. Not like a plot or anything, but what exact sequence of points do you want to lead your audience through in order to both hold their attention and also inform them on the most important ideas. And if a certain bullet point or graph derails a story that you're trying to tell, it's probably best to leave it off or to restructure it in a different way. So those are the top 5 skills that I think anyone that wants to work on a trading floor, whether at a bank or at a hedge fund, should have. And this list may seem pretty daunting at first, but a lot of the skills that I mentioned take a lifetime to get really good at and to master. So don't be stressed if any of the skills that were on this list are something you're not too familiar with or are not too comfortable with. I'm still just beginning to learn many of these things myself, and I'm working on them every day. And that's one of the reasons why I love the finance industry. It's because you're constantly learning and you're always trying to get better at what you do. Anyways, if you guys found this helpful, please do leave a like, subscribe, and I'll see you guys in the next one.